Welcome to another episode of Mutual Growth, a podcast by Penn Community Bank. I'm your host, Aaron Clark. Today, we're once again joined by Dorothy Jaworski, Penn Community Bank Director of Treasury and Risk Management, to get her thoughts on the state of the economy and her forecast on what comes next. After the show is over, be sure to check out the show notes and links to resources at penncommunitybank.com/podcast.
All right, Dorothy Jaworski, welcome back to the show.
Thank you, Aaron. Good to be here.
Always excited to have you on for our regular economic updates, and certainly a lot to cover, as always, during our conversations. But since this is our first conversation of 2022, or 2023, let's look back at 2022 and kind of give a recap, especially since now we know there's maybe been some revisions on quarter four's economic numbers. Where did we leave 2022?
Well, 2022, I think like most people, I would prefer to forget it. We had a lot of, volatility, to say the least. GDP growth, we started off the year, if everybody recalls, with 2 negative quarters of growth. So there was the great debate as to whether that's a recession or not. And then we were followed by the last 2 quarters of the year were positive. So we ended up okay. For the whole year. The Fed started raising rates. They started their great fight against inflation. And they started in March of 22. Even though they knew about inflation in the summer of 21, they waited that long. So I think that exacerbated, some of the, effects of the bond market, et cetera. The Fed raised rates of 425 basis points from March to December, which is incredible. The largest increase in a year prior to that was 1994, when the Fed raised rates 300. And I thought that was a lot. So 425 basis points is a huge amount. As I mentioned, inflation, that peaked at 9% in June, the CPI. And the Fed was worried about that. And of course, all of us were worried too. Stocks took a big hit, with the Dow down 9%. S&P was down almost 20%. And NASDAQ was down a whopping 33% for the whole year, which is just incredible. But the one thing that was kind of different in 2022, bonds were down very large too. And that's because the Fed was raising rates. Bond prices were falling at the same time that stock prices were falling. Generally, one will offset the other. That's why people mix their portfolios. But bonds were down. If you look at most of the aggregate measures, they're down about 13% last year. That's total return. That's price change minus the interest. So price change is a little bit larger than that. GDP growth, I mentioned, picked up in the final 2 quarters. We were up about an average of 3% in the second half of the year. And I attribute a lot of that to inventory building. So companies have to work off those inventories. If they do, that's great. If they don't, they're going to have to lower prices to get rid of it. So, it could be good or bad. We were seeing a little bit of weakness in December in terms of spending. And that certainly reversed. You mentioned revised data. We got revised data for December and also January. January was very strong for the consumer. Consumer spending was up 1.8%. Retail sales were up 3% just in 1 month, which was incredible. There's been no explanation for why it was that high. Maybe it was just the hangover from the holidays. I don't know. But the unemployment report was also very strong. The unemployment rate fell down to 3.4% in January. That's like a 50-year low. And the number of jobs created was over 500,000, which is very unusual for a January when you figure most of the seasonal workers for the holidays are being let go, or they're ending their commitments. So, it was a very strong, report. This all made people really be afraid is going to just continue to raise rates endlessly. At some point, they have to stop, but they will respond to the strong data if it's going to prove to be inflationary. So they'll probably watch the next, report or two on the CPI to see, what's happening there in terms of the trend.
Well, speaking of the next report or two, we're well into quarter one now. We're well into 2023. You kind of went over some of those data points. What's the economic feeling right now for the year beginning, and where is it kind of guiding some of those decision makers?
Yeah, we're starting 2023. A lot of us are surprised that we started so strong in January, because we saw weakness both in November and December, but it really didn't carry through into January. So we're starting off a little stronger than we expected. The Fed raised rates February 1st, for the, 1,000th time or whatever the number is. They're now up to 450 basis points of tightening in total. And they're expected to go to 5%, at this point. That's at least what the market is expecting. Consumers spent a lot in January, and the Fed's going to be upset because they want to slow demand, not allow it to be so strong. Stocks and bonds both started out January, both looking pretty good, and then by February it all turned around. Stocks were down. They have fallen probably about 5% so far in February. And bonds are up 50 to 60 basis points in February alone. So, that's a terrible result. So both bonds and stocks are getting hit at the same time again. The Fed, I mentioned raise rates. They're expected to meet, when they meet in March, they're expected to raise another 25 basis points. Back in 2022, there were 4 times when they raised them 0.75% at a time. That was a huge increase all at once. The 0.25 is kind of their standard normal increase. So, I believe by them reducing down to that amount, they're close to the end. I can't tell you when the end will be, but I think they're close to the end. But, as strong as the consumer looks in January, some businesses are struggling. I've seen a lot of layoff announcements, especially technology companies. Manufacturing, a lot of those reports are, very weak when you look at them. Housing is still in bad shape. Every once in a while we'll see a spurt, but, overall, it's very, very weak. Mortgage rates are approaching 7% again, and that really slowed housing mid-year last year. Then it recovered some. So we're seeing those effects. And, weakness is evident in most of the data, especially business surveys, such as the ISM, which is the Institute of Supply Manufacturers, and the Philly Fed, which they survey, companies in this area, both manufacturers and service companies. Those surveys have been very weak recently.
So just kind of focusing on the Fed here, we've talked about the Fed's rate hikes, that's the card they had to play in the economic situation we found ourselves in, right? You talk about the historic basis point increases, kind of waning off now a little bit. What do you think kind of overall the impact has been? Has this regimen been successful for the Fed? Has it accomplished what they set it out to do? Obviously, you don't have the crystal ball to see what the Fed will do moving forward, but what's been the success of this tactic?
Yeah, well, anytime there's inflation, everyone expects the Fed to raise rates. The question is, how much do they raise them? So, I believe they've raised them, sufficiently already. Some people say they have more to go. You really don't know till it's over, because like you said, there's no crystal ball to say, here's exactly when inflation's going to come down. So, the Fed raised rates by a historic amount in that, in the single year. And that aside, back in the 1980s, the Fed was raising rates, interest rates got up into the teens. And the Fed was raising rates back then like 400 basis points in a year. But it, proportionate to the level of rates, it was a lot different back then. And the situation was different then. But so far this year, rates are up, I mentioned 50, 60 basis points. From the end of 2021, when the rising rate environment began, the 2-year Treasury is up over 400 basis points. I mentioned the Fed has tightened 450 basis points. The 10-year Treasury is up about 240 basis points. And keep in mind, the short-term rates move a lot more than long-term rate. And mortgage rates moved up about 350 basis points. So, that is hurting, the housing market a little bit. But the biggest impacts are, definitely going to be on businesses. Any business with a line of credit where they're paying prime as their interest rate, that's up 450 basis points. It's a lot of interest for, a full year. That's financing for their operations and also buying inventory. So they need to clear the inventory more quickly or maybe not buy as much. It's a kind of a catch-22 for them. Housing, I mentioned that, that has suffered. Home prices, they were rising dramatically on a year-over-year basis, as recently as the fall, up 10% year over year. Right now, it's a couple percent year over year. And new home prices are actually down almost 1% year over year. So, the trend is reversing. There's a lot of inventory on the market for new homes, and builders want to clear that out. So I believe they're cutting prices, giving concessions to cause that. Existing home sales on a year over year basis are up about 1.3%, the most recent reading we have. Manufacturing slowed. The Fed's trying to reduce demand, so that it's certainly working on the business side for sure. But there's still supply chain issues on products like, semiconductor chips for cars. It's still you can order a new car and it might take 3 months to come in. My nephew just bought a new Honda, and it took him, he just got it in early February and he ordered it around Thanksgiving. So that's a long time to wait. There's also one of the big things that the price was soaring initially in the pandemic was lumber. Now sometimes there's shortages. So it's kind of ironic that lumber's back in the news, for a different reason. Trucking shipments, I watch that a lot. They have been down 5 months in a row. So they're delivering less. So that's not a rip-roaring economy to me. That's a weakening economy. Pent-up demand, of course, is still there for services. After we came out of the pandemic, people wanted to go back out to eat. They wanted to travel. They wanted to use hotels, go to entertainment, concerts, things like that. And, everybody wants a great vacation. So there's going to be a lot of demand, I believe, for vacation and, entertainment and stuff this summer. So I think that'll keep us, keep the economy moving somewhat. One of the impacts is, of the Fed hiking rates, is that inflation is actually falling. They have been somewhat successful. They wish it was quicker, but, CPI peaked at 9% year over year in June. It's now about 6% year over year. So it's cut down by about a third. And a lot of their, the large rate hikes didn't take place till the summer. So with a 6 to 9 month lag, which is normal for Fed activity, we may not see that until the next upcoming, quarter or so. And, finally, the Fed, one of the things that I find very interesting and no one watches anymore, excuse me, the Fed has been successful at reducing the money supply. So if everybody pulled out their economics textbooks from way back and looked at it, when the Fed's raising rates, money supply will go down. Money supply, if you increase it a lot, it can be inflationary. And that's exactly what happened in 2020 and 2021, that the Fed raised the money supply by, say, 20%. It was outrageous amounts. Contributing to that was our government also doing stimulus and handing money out. Right now, we've had 2 consecutive months of year-over-year declines in the money supply. December and January, negative 1.1% and 1.7%, which I just found on the system today. These are the only negative monthly prints that I've seen on a year-over-year basis, going all the way back to 1960, which is as far back as my database goes. Wow. That cannot be good. But the Fed has accomplished something. They've reduced that money supply, so now it's actually declining. So in my mind, it cannot be good. That could be a reason for them to pause and assess what they've done. Pause for a few months. I don't see any harm in doing that, but I do believe they have raised rates too much to cause this situation where money supply is down. And if you remember what's in money supply, deposits are in money supply, and they are declining banking industry-wide. So the Fed is accomplishing that. Money supply, it's naturally going to pull inflation down. If you believe Milton Friedman, if we go back and look at our textbooks, he's mentioned everywhere. He said, inflation is a monetary phenomenon. So, if you increase the money supply, you're going to get inflation. If you reduce the money supply, you'll get deflation, reduced inflation. So, it's very interesting.
We're assigning homework to our listeners here. They're pulling out economic textbooks as they go.
Right.
You mentioned, Dorothy, and I know we always touch on this. You mentioned, what databases you're looking at or what indicators you're going to kind of get a sense of where we're at and where we're going. Can you give us a snapshot of what our leading economic indicators are telling us right now, and for folks listening at home, what they should be looking at to be informed?
Yeah. Well, I always look at, I have several favorites, like most people do. You get attached to these pieces of data and you wait for them to come out each month or each quarter. But one of my favorite ones is the leading economic indicators, and its direction. It comes out on a monthly basis. Its direction points to what the economy is going to be doing 6 to 9 months later. Right now, January was negative 0.3. Following December was negative 0.8. And it's actually been a negative number for 10 months in a row. So there has never been a series of negative prints that have not produced a recession. So if you look back in history at this indicator, so a lot of the signals from these indicators are flashing either really slow growth or outright recession. You can never tell till you're there, almost. Another one I look at is the leading inflation index. And that turned down starting last May. And it's been down most of the months. It did rise up a little bit in January. So, not a lot, but just it ticked up. And I was disappointed that the downtrend was broken, but it's still 6% below its peak. So that's a good sign for future inflation. You don't have to look any further than stocks to know what, they think about the future. Stock prices are falling, and they're seeing, reduced revenues, maybe tighter profit margins for the different companies. If growth is slowing, that's going to be a natural thing. So, that's one of the trends from, that stocks can really, clue you in on. The yield curve is another one. I look at, I have to work with rates every day, in my job, but I look at the yield curve, not necessarily where the absolute rates are, but what's the difference between the points along the curve. And right now we have what's called an inverted curve, where, it's not normal. Short-term rates are higher than long-term rates. Usually it's the exact opposite. And what's happening is, the Fed controls short-term rates. So they're going to be somewhere around the Fed funds rate. And the long-term rates, they move with inflation and everything else. So they believe inflation is not going to be that big of an issue come in a couple years. If you look at maybe this first year, yes, it could be high. But, 5 to 10 years out, they don't see it being much more than, say, 3%. But the curve right now, the difference between the 10-year point and the 3-month point is negative 0.85. And that's pretty large. Although, some of the curve inversions we've seen in the past, if you kind of averaged out maybe the last 4 of them, it's negative 1.16, I believe, is the average. So it can get worse. And, if you think about that, banks are funding on the short end and lending longer. So if it becomes too inverted, banks might not want to put assets on under their funding costs. It can create a really terrible environment, for everybody if that happens. But, the reason I like the yield curve and watching for inversions, since 1968, I went back and looked this up. There's been 8 inversions of the yield curve and 8 recessions followed. Typically, there's going to be a lag. It's anywhere 6 to 18 months. If it occurred 5 years later, no, we're not going to count that, but anywhere in that 6 to 18 month range. Also, you can tell what most people think about the economy by surveys that come out. And I mentioned Bloomberg before. They do a survey every month that they publish. They're asking about 30 economists throughout the U.S., what their views are. 61% of them believe we'll have a recession in 2023. So, that's a higher percentage than you want to see. But they collectively project an average of 0.5% in GDP this year. So if we have recession and then we have some bounce back in growth, to average above 0 is probably a good thing. That tells me they're not projecting anything horrible, just natural slowdown from the Fed raising rates. And then, I personally believe that we'll have a recession. I don't think it'll be monumental unless we go into recession and the Fed keeps raising rates, or they don't eventually stop and pull them back down. If money supply is continually contracting, that could be a terrible situation. And we don't have any experience with that because I couldn't find any, negatives going back all that time. So, it's going to be a very interesting period.
One thing that you mentioned, and certainly folks that are out there have kind of seen, whether they're in the market or just kind of operating in their communities, has been the housing market. You mentioned kind of where that's been trending due to rates, due to inflation just generally. Can you give us any insight moving through the rest of 2023 about that housing market? And additionally, other common commodities that people kind of base what they see the impact of inflation on, whether it's gas or home heating oil, used cars. You mentioned, semiconductor chips. What other kind of commodities are people seeing, and what is that showing?
Yeah, Aaron, housing, it's probably the most rate sensitive sector that we have in our economy. It was the first to react and start to, existing home sales started to drop right away when the Fed started raising rates. I mentioned earlier that the 30-year mortgage rate went from 3.25% about the end of 2021 to close to 7%. Right now, it's about 6.75%. Now, if you look at that on a, say someone's purchasing a house and it's a $300,000 mortgage, the difference in payment is going to be $640. It's incredible. And that's just a month. So that's not even including taxes that might go up. So that's a real affordability issue for a lot of people. They'll look at that and say, I'm going to just hold off for now. If you can afford it, go ahead, because chances are you'll get a chance to refi later. Mm-hmm. But, if you can't afford that payment right now, it's a difficult thing. Maybe try to just save more and come up with a bigger down payment. It's an affordability issue for sure. I mentioned existing home sales. They've been declining for 12 straight months. And it's because the Fed's raising rates. New home construction, that's down right now because builders have excess inventory that I mentioned. And the way to measure inventory is how many months worth of sales are on the market. Right now, new homes have about 9.5 months worth of sales on the market. That's a lot. 6 is usually a normal economy. Existing home inventories, it's 2.9 months, say 3 months worth of sales. So that's extremely tight. And that's accounting for, there's not a lot of sales because there's not a lot of product on the market, but it's also propping the price up. So I do believe, I don't think we'll see huge declines in price because that phenomenon is probably going to go on for a while, and it'll keep prices up there. Other commodities you asked about, new and used car prices, they're all over the place. They've soared, they've come back down, then they've, gone back up again. It's kind of a function on the new car side as to whether there's any supply chain issues, but what's being an impact there too is auto, like if you do an auto loan to buy a car, that rate is up. It was 2% at some point, maybe, used cars might be a little bit more, but new cars, they were 0 to 2. Now suddenly they're 7 and 8%.
Right.
There's a couple out there maybe doing a 0, but it's very hard to find and very hard to qualify. So yeah, that's affecting people as well. So higher rates are, hitting that sector because it's rate sensitive too. The price of oil has been remarkably steady recently. It's really natural gas that's kind of, it's a supply demand thing. They thought Europe was going to need a lot of natural gas because Europe was cutting them off, or not Europe, Russia was cutting them off. So they thought that there was going to be high demand, so everybody was shipping natural gas over to them, and they didn't need it because it was a warm winter, just like we've experienced here. So, that kept natural gas from rising even more, but it's still up 53% year over year, which is incredible. So it's got to be supply type issues. Oil has been very steady in a range of about, $75 to $80 a barrel. And if you've noticed gas prices, when you go to the pump, they fall a little, they, go up a little, but they're still in the same range, $3.50 to $3.60-ish, maybe even a little less now. So, that's kind of stabilized. And then one thing I wanted to mention too, I put this in my quarterly newsletter. The price of eggs is one of the highest price increases I've seen in any commodity. This year it's about $3.70, I believe, for a dozen eggs. It's up 109% year over year. Some of that is just inflation. Some of that is this bird flu that's going around. And there's not enough chickens to lay eggs. That's hurting us all because we all have eggs,
It's always something new, right? There's always something to talk about, for sure. One of the things that you mentioned earlier that caught my attention here, Dorothy, was talking about a historically low unemployment rate. But at the same time, we're talking about kind of an inflationary environment. Is the economy really growing? Are we settling down? So, for folks that are out there hearing that and going, all right, well, how do we square this circle? What's the workforce participation, hiring, wages? Where's the disconnect between those numbers, and how do you make sense of what people are seeing and feeling out there about jobs?
Yeah. Well, the job growth, I mentioned January, was surprisingly high. It was over 500,000 new jobs, reported in January. And that's a month where usually you see seasonal workers, ending their jobs. At the same time, the unemployment rate fell down to 3.4%, which is the lowest since the late 1960s, 1970. There's only, it's a lot of people, 6 million people unemployed. Usually we've seen 10, 12, 15 million unemployed at different times. So right now it's only reported as 6 million people. And job openings are at 11 million as reported, nationwide. So that's like 1.7 to 1.8 jobs for every unemployed person. Yet employers still report that they have difficulty in hiring people. So, it's a very hard one to figure out. You mentioned the labor force participation rate. January was 62.4%. And, how does that compare? I looked back to right before the pandemic began in 2019. That was 63.2. So, it was not a great level then, but, still almost 1% higher. So that's about 2 million people different. 2 million fewer people working now than were back then. So whether it's retirements or they just dropped out of the labor force or, whatever the reason, eventually we will figure out and settle the number. Right now, you can't explain the whole number. It's a little mysterious. I used to call it the MIA, missing in action. Where are these people?
Right.
You always have to wait and get the data, and then finally someone figures it out. The Fed was concerned that too low an unemployment rate will lead to wage inflation. And they're right. If it continued on at, it was 5 to 6% wage inflation back in like 2021. So they wanted to reduce that back. It's now reported at 4.4%. So they have been successful in reducing that, much to our chagrin, because we're employees that want to see wage growth. But, for the overall economy. And, I was just reading an interesting article that the Fed would like that year-over-year increase to get down to 3.5%. They have a target of 2% on inflation. And they also would say that, adding 1.5 points for productivity growth that's shared by corporate America adds up to the 3.5%. That would be a non-inflationary type, level that they'd like to achieve. And they're not that far from there. So that's another hope that maybe they're not going to continue to raise rates forever. The Fed's worrying about the economy being too strong because demand will continue to push prices up if it goes unchecked. But, the rate of 3.4%, they would like to see that in the 4s or 4.5 or something, not to, see people lose their jobs, but it's a necessary adjustment that the economy has to make.
So all these things together, right? All your indicators that you're looking at, kind of the track record of where we've been, certainly the Fed's involvement, the other policy considerations. How does kind of Q1 shake out? How do we move into spring and summer 2023, and what can people kind of expect economically?
Yeah. Well, I mentioned the projections that the economists make. For the first quarter, they're projecting anywhere from 0 to 0.2. Now, we already saw a strong January, so I think it's going to be more than that. And the Atlanta Fed publishes a projection for the quarter we're in all the time. They think it'll be 2.7%. So it's a real difference between there. I think probably somewhere in the middle, because of that strong January. We'll have to see where February comes in. But, from the fourth quarter, if you compare it going into the first quarter, manufacturing's down, inventory building was a lot of the growth in the third and fourth quarters. That may not recur. So, I do believe we'll be, probably under 2% this quarter. And it's in terms of when is that recession going to come? Eventually it will come. The Fed has raised rates enough. There's enough weakness. They'll raise them more and more and more till they get the recession they want. Maybe a downright, decline in growth for a couple quarters. So this, we're looking at the second half of the year. And that would be in line with, when did all those big rate hikes occur? The last one was November. 6 to 9 months later takes us well into the summer to feel those effects. So, I think I'd agree with, the economists. They're looking at maybe about 0.5% growth this whole year. Some downs, some ups, offsetting, it's still positive growth. It's still a win. If they stop raising rates so quickly, we may not even see recession. I hate to say that because I really do think recession's coming from the inverted yield curve and everything else. But, if, say, the Fed was to say, okay, we're going to stop raising rates and, the battle against inflation is over, look how it's falling. That could change a lot. But right now, I do believe we'll have those couple negative quarters later in the year. And then, a couple positive quarters early. So we can average out to be that 0.5 and not show a down year at all. So that, fingers crossed for that kind of scenario. The only thing I don't know what the harmful effects of the money supply being, growth being negative is going to be. I'll have to pull out my textbook and kind of read up on that so, for the next time.
Plenty of homework abounds, and certainly sounds like one way or the other, a year worth of conversations for us to have here, Dorothy. We look forward every time to having you on to kind of break down the economy. We'll look forward to next time. In the meantime, we'll include in the show notes the link for everyone to sign up for Dorothy's economic newsletter that she referenced, a really great piece of material to kind of make sense of what you're seeing and feeling out there. But as always, Dorothy, thanks so much for taking a few minutes to walk us through this. And we'll see you next time.
Thank you very much, Aaron. I appreciate it. It's been a pleasure.
I hope you've enjoyed this episode of Mutual Growth, a podcast by Penn Community Bank. Be sure to subscribe and leave us a rating. And as always, keep up with the latest from Penn Community Bank by following us on Instagram, Facebook, and LinkedIn. For more information about this podcast, links to past episodes, or to learn more about Community First Banking, just visit penncommunitybank.com/podcast. Mutual Growth is the official podcast of Penn Community Bank, member FDIC, equal housing lender. It is produced for the benefit of current and prospective customers and partner organizations. This program is provided solely for educational and entertainment purposes. The information contained herein is based on sources believed to be reliable, but is not represented to be complete, and its accuracy is not guaranteed. The opinions, views, and estimates expressed are those of the presenters at the date of production and are subject to change without notice. Please email marketing@penncommunitybank.com regarding booking or repurposing any part of this podcast.